I think that now is a great time to invest in the preferred shares of real estate investment trusts, and there's two reasons for this. Firstly, many REIT preferred shares are still today heavily discounted relative to their par value, and as a result they are offering high dividend yields of up to 8%. Secondly, it now appears extremely likely that the Fed will cut interest rates quite significantly in the near term, and I expect this to lead to a recovery in the preferred shares of many REITs, potentially leading to quite significant upside. And so as a result, many of these REIT preferred shares are today offering high yield and upside potential, which combined together should lead to very strong total returns going forward in the 15 to 20% range in the coming years. That's very attractive coming from relatively safe preferred equity investments, and therefore I really like the risk reward of REIT preferred shares at the moment. Hey everyone, this is Jules. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to highlight two of my favorite REIT preferred share opportunities yielding up to 8%. But before I get into it, I want to remind you that we just recently launched a new YouTube channel that highlights some of our favorite non-REIT investment opportunities. So there we discuss things like MLPs, BDCs, preferred shares as well, and many other sectors of the market that offer high dividend yields. If you want to check it out, I'll put a link to it in the description of this video. So the first preferred shares that I'm going to discuss here are the Series A preferred shares of KKR Real Estate Finance, which is a mortgage REIT that's managed by KKR. Its ticker symbol is KREF.A. These preferred shares are today still priced at a near 20% discount to their par value, and they're offering an 8% dividend yield, and I think that there is one main reason for this. Earlier this year, the company cut its common dividend by 42% in order to preserve more cash flow as it prepares to face some loan defaults. Naturally, this caused the common stock of the company to crash down, but the interesting thing here is that it also dragged down the preferred stock of the company, despite the dividend cut actually making it safer. Because you need to remember here that the preferred equity is senior to the common equity on the balance sheet, and therefore the interests are a bit misaligned in some cases between the common equity holder and the preferred shareholder. The common equity holder obviously would like to get high dividends, and so naturally I understand why it didn't like the decision for the dividend to be cut, but from the perspective of preferred shareholders, this is great news in a way, because it will allow the REIT to retain more cash flow, which makes the preferred equity even safer. The market here appears to have been surprised by the REIT announcing that they expect to suffer some loan losses over the coming quarters and years, but it really shouldn't have been, in my opinion, because it's well known that most mortgage REITs lend capital too aggressively when interest rates were ultra low in 2021, 2022, and therefore now, following the surge in interest rates and the expansion in cap rates, some of those loans have become very risky and are likely near defaulting. To give you an example, let's assume that the mortgage REITs lend capital to another real estate investor with a 70% loan to value based on a cap rate that was 4.5%. They might have thought that this was conservative back in 2021, but then interest rates surged and cap rates expanded, and if that cap rate expanded, let's say, to 6.5%, now suddenly the LTV would have gone from 70% dangerously close to 100%, which could have triggered a default. This is especially true because most mortgage REITs are lending with variable rates, and therefore with the surge in interest rates, this led to more cash flow for mortgage REITs, but it put even more pressure on the borrowers. These loan defaults obviously are not good news for mortgage REITs like KKR Real Estate Finance, but it's not the end of the world either. These REITs are lending money to earn interest income, and they know very well when lending this money that some loans will default down the line. There will be more defaults than usual in 2024 and in 2025, but these REITs will simply foreclose on the properties, start operating them to earn rental income, perhaps make some improvements to them, and as market conditions improve, likely in 2025, 2026, as interest rates return to lower levels, they will then sell the properties to recoup their principal and reinvest these proceeds into new loans to grow their cash flow. I think that KKR Real Estate Finance is especially well positioned to go through this down cycle because it's sponsored and managed by KKR, which is one of the leading private equity real estate investment firms with about 70 billion of real estate capital under management. They are managing many other real estate vehicles that could be in a strong position to acquire some of these troubled properties from KKR Real Estate Finance, and therefore I view this sponsorship by KKR as a competitive advantage. Also, it's important to keep in mind that while the REIT will face some loan losses, overall its portfolio is doing quite well. All of its loans are senior secured, they are collateralized by mostly multifamily and industrial properties, which are today doing well and holding much better their value than some other property sectors like office. And then finally, the average LTV of its loan portfolio is today only 66% based on today's cap rate. That's quite conservative because I don't think that cap rates will expand much more from here. On the contrary, I think that they are now stabilizing and likely to return to slightly lower levels, which would increase property values and give this REIT even more margin of safety. They have about 24% exposure to the office sector. However, here it's also important to note that these are all Class A new build properties with very long leases with, I think, an average lease term of about 10 years. And so this provides good margin of safety in today's environment. Therefore, I don't expect widespread defaults across its loan portfolio. I just expect some exceptional losses. And here's what the management said on a recent conference call. Today we have a few assets where the best path forward to maximize value will be to take title, operate the real estate, stabilize cash flow before selling. Each has different circumstances, but this is high quality real estate. We have full confidence we'll lease and stabilize over time. To put it simply, we have great real estate, we have ample liquidity, and we have the resources and expertise to create value. Once stabilized, we believe we can sell the real estate at a higher value than our current mark. We cycle that capital into cash flowing assets and return to a more normal level of operating earnings. However, getting to stabilization will require time and impact earnings in the interim. To that end, our board of directors declared a dividend of 25 cents per share for the first quarter. So clearly what the management is telling here is that this is a temporary issue. Yes, they are facing some loan defaults because cap rates expanded significantly as a result of the surge in interest rates, but now interest rates are already starting to return to lower levels and the REIT is simply acting opportunistically. Some of its borrowers have defaulted on their interest payments and so they are now foreclosing on those properties to gain possession of them, and as market conditions improve, they will simply sell these properties and they expect in some cases to even earn a gain on those sales. Because keep in mind again that they lent with LTVs in the 60 to 70% range, then cap rates expanded so the LTVs went closer to 90 to 100%, but then they foreclose on the property and let's say market conditions improve and now they sell it at 110, they pocket a little profit in there. In the meantime, they're operating the asset, earning rental income. It's really not the end of the world. The REIT market just doesn't like the bumpiness and the resulting dividend cut in the interim, but if you're thinking long term, this is not a major issue for the REIT, especially considering that they don't have any major debt maturities in 2024, 2025. They have some more in 2026, but by then interest rates should have returned to lower levels. And again, also keep in mind, we are not investing in the common equity, we're in the preferred equity, which is senior on the capital stack. Before the common stock investors get even just 1 cent of dividend income, the preferred dividend need to be paid in full. And this also applies to liquidations. If the REIT ever wanted to liquidate, the preferred shareholders need to recoup 100% of their capital at par value before the common shareholders even get just 1 cent. And I think that this provides us great margin of safety. Despite that, preferred shares are today heavily discounted, offering an 8% dividend yield. And I think that eventually now, as interest rates return to lower levels, market conditions improve, the shares are going to reprice at closer to par value, leading to an additional 20% upside. Now, if we assume that it takes 2 to 3 years for this upside to be realized, you add the 8% dividend yield, that would result in 15 to 20% annual average total returns over the coming years. I think that's very attractive coming from a preferred equity investment. And for this reason, we've been investing in the Series A preferred shares of KKR Real Estate Finance as part of our retirement portfolio at High Yield Landlord. If you want to access our entire portfolio, we're still offering a limited time 2-week free trial. I'll put a link to it in the description of this video. You won't be charged anything in the first 14 days. You can just join to access our portfolio and then cancel within the first 14 days. Perfectly fine with me. And then if you decide to stick with us for the long run, you'll get an additional 20% discount. Then the second preferred shares I'm gonna discuss are the Series M preferred shares of Vornado Realty Trust, which is a New York City focused office REIT. The interesting thing here is that the common equity of New York City office REITs have strongly recovered over the past year. SL Green, which is the leading REIT in this market segment, has roughly tripled in value since March of 2023. Then Vornado Realty has also more than doubled since May of 2023. However, for reasons that I know, its preferred equity has kept stagnating behind, likely because there simply isn't much liquidity in this preferred equity investment, and as a result, it's still priced at a near 40% discount to its par value. And I think that this is an opportunity. I think that there's just a lag between the reaction of the common equity, which is far faster than the preferred equity in this case. And I think that the common equity market has nicely captured the improving fundamentals of the sector. Companies are now gradually returning to the office. The market has understood that supply-constrained markets like New York City will eventually recover. Leasing conditions have begun to improve. Interest rates are now headed lower in the near term. Debt maturities are being extended by these REITs very successfully. They have significant liquidity to deal with the challenges. And since Vornado is not paying any common dividend, it's able to retain all of its cash flow to keep deleveraging gradually over time. Here's what the company's CEO said on a recent earnings call. I continue to strongly believe the contrarian bull case I made in my annual shareholders letter that basically with frozen supply, no new developer office starts, and vacancies shrinking, I couldn't be more optimistic about the future. Our team here at Vornado couldn't be more optimistic. That's a pretty strong statement coming from the CEO of an office REIT, and I think that they have good reasons to be optimistic because conditions are now finally starting to improve. The REIT has a big development pipeline that's not earning cash flow yet. It's retaining a lot of cash flow to keep deleveraging, and therefore I'm quite optimistic, especially for the preferred equity shares, which today remain heavily discounted relative to their par value. I think that as interest rates return to lower levels, Vornado makes more progress deleveraging its balance sheet, and the office market conditions slightly improve. We will see a strong recovery in the preferred shares of Vornado Realty. Again, the recovery has already taken place for the common equity side of the market, but for reasons I ignore, the preferred equity remains heavily discounted with a 40% discount to its par value and an 8% dividend yield. I think that you could expect here potentially even more upside than in the case of KKR Real Estate Finance. For it to return to par value, it would need to appreciate by over 40% from here. And while that might be a bit of a stretch, even let's assume that they keep trading at a slight discount, you could still expect 30% upside from here, which is quite significant for preferred equity investment. While you wait patiently, you will keep earning an 8% dividend yield, which will only become more and more attractive to investors now as interest rates return to lower levels. We hold many similar preferred equity investments in our retirement portfolio at High Yield Landlord, which aims to maximize safe income. And if you want to access our full portfolio, we're offering a 2-week free trial, as I mentioned earlier. There is a link to it in the description of this video. And otherwise, if you could please click the like button and subscribe to the channel, that will help me a lot to keep on growing. Let me know what REIT I should cover next in the comment section below. Thank you so much, and see you at my next one. Bye-bye.